In the labyrinth of economic indicators and Federal Reserve tea leaves, August's inflation report emerged unexpected plot twist, leaving economists, policymakers, and ordinary Americans scratching their heads. As we navigate these turbulent economic waters, it's worth taking a deep dive into what these numbers mean for our wallets, our futures, and the very fabric of the American dream. The inflation surprise. On a warm Wednesday morning, as many Americans were sipping their coffee and scrolling through their phones, the Bureau of Labor Statistics dropped a bombshell: core inflation, the metric that excludes the volatile food and energy prices, had ticked up to 0.3% in August. This seemingly innocuous number sent ripples through the financial world, causing a recalibration of expectations and a collective intake of breath among Fed watchers. To put this in perspective, imagine you're on a diet. You've been steadily losing weight for months, and suddenly, despite your best efforts, the scale shows a slight increase. That's essentially what happened with inflation in August. After months of gradual decline, giving hope to consumers and policymakers alike, inflation decided to flex its muscles once again. The devil in the details. Diving deeper into the report, we find that the culprit behind this inflationary uptick is an old familiar foe: housing costs. The shelter component of the Consumer Price Index, CPI, rose by 0.5%, the most significant jump since the beginning of the year. For many Americans, this isn't just a statistic. It's a lived reality. From young professionals in bustling cities to families in suburban neighborhoods, the cost of putting a roof over one's head continues to be a significant burden. But it wasn't just housing that pushed inflation higher. Airfares took off, clothing prices stitched together an increase, and even the cost of daycare and preschool saw a bump. It's as if inflation decided to touch every aspect of the American lifestyle, from our homes to our vacations, our wardrobes to our children's education. The Fed's dilemma. For the Federal Reserve, this inflation report is like a curveball in the bottom of the ninth inning. Just when they thought they had a clear path to potentially easing monetary policy, inflation throws them a surprise. The central bank, under the stewardship of Jerome Powell, now faces a delicate balancing act. On one hand, there's been growing pressure to cut interest rates. The job market has shown signs of cooling, with hiring slowing and job openings declining. Many businesses, especially in sectors like tech and finance, have been tightening their belts, either through layoffs or by being more selective in their hiring processes. This softening in the labor market has been a key argument for those advocating for rate cuts. On the other hand, this unexpected inflation uptick serves as a stark reminder that the battle against rising prices is far from over. The Fed's mandate is twofold: maintain price stability and maximize employment. With this latest report, the price stability part of that equation just got a bit more complicated. The market reaction. As news of the inflation report spread, financial markets reacted with their typical mix of drama and precision. The probability of a significant rate cut in the Fed's upcoming meeting plummeted to near zero. It was as if the market collectively realized that its hopes for monetary easing were a bit premature. Treasury yields, those ever-sensitive barometers of economic expectations, inched upwards. The stock market, which had been on a bullish run, took a moment to catch its breath, with the S&P 500 opening lower. Even the mighty dollar, which had been on the back foot, found some strength in the face of this inflationary surprise. But beyond these immediate market reactions lies a deeper question. What does this mean for the average American? The American consumer, caught in the crossfire. For John and Jane Doe, sitting at their kitchen table in any town, USA, the intricacies of core inflation and Fed policy might seem distant and abstract. But the reality is that these economic forces shape their daily lives in profound ways. Take housing, for instance. The continued rise in shelter costs means that for many Americans, the dream of homeownership remains frustratingly out of reach. Young couples saving for their first home find the goalposts constantly moving. Renters, especially in urban areas, see an ever larger chunk of their paychecks going towards housing. Then there's the broader impact on consumer behavior. With inflation proving stubborn, many households are forced to make tough choices. Do we go on that family vacation we've been planning? Or do we tighten our belts? Can we afford to enroll our child in that after-school program? Or should we look for cheaper alternatives? These aren't just economic decisions. They're life decisions that shape families, communities, and ultimately the nation. The silver lining? Amidst this seemingly gloomy picture, there are glimmers of hope. Real earnings, which take into account both wage growth and inflation, grew by 1.3% compared to a year ago. This is the most significant increase in over a year, suggesting that for many workers, their paychecks are finally outpacing rising prices. Moreover, while core inflation ticked up, overall inflation, including food and energy, continued its largely thanks to falling gas the average American up their car or heating their home. This provides some much-needed relief. The bigger picture, America's economic resilience. As we zoom out from the minutiae of monthly reports and daily market fluctuations, a broader narrative emerges, one of American economic resilience. Despite facing unprecedented challenges, from a global pandemic to supply chain disruptions and geopolitical tensions, the U.S. economy has shown remarkable adaptability. Unemployment remains low by historical standards. Innovation continues to drive growth in sectors ranging from technology to renewable energy. American businesses, from small startups to multinational corporations, continue to find ways to adapt and thrive in an ever-changing economic landscape. This resilience is a testament to the underlying strength of the American economic system and the indomitable spirit of its workforce. It's a reminder that while we may face challenges and setbacks, the long-term trajectory of the American economy remains positive. The global context. It's crucial to remember that the U.S. economy doesn't exist in isolation. As we grapple inflationary challenges, other economies are facing their own hurdles. The European Union is navigating a complex economic landscape, with different member states experiencing varying levels of inflation and growth. China, long the growth, is facing its own set of challenges, from a property market crisis to demographic pressures. In this global context, the U.S. economy's performance, despite its challenges, looks even more impressive. International investors continue to view the U.S. as a safe haven, a vote of confidence in the country's economic fundamentals and its ability to navigate turbulent times. The role of technology and innovation. As we look to the future, it's impossible to ignore the transformative role of technology and innovation in shaping the economic landscape. From artificial automation to renewable energy and biotechnology, these advancements are not just changing how we work and live. They're reshaping the very nature of economic growth and inflation. Take the gig economy, for instance. Platforms like Uber, DoorDash, and aired new forms of employment and income streams that don't always fit neatly into traditional economic metrics. How do we measure inflation in an economy where services are increasingly personalized and on demand? Or consider the impact of e-commerce and digital marketplaces. While brick-and-mortar stores might be raising prices, online competition often exerts downward pressure on prices. This digital deflationary effect is hard to capture in traditional inflation measures but plays a significant role in many consumers' lived experiences. As policymakers and economists grapple with these new realities, it's clear that our understanding of inflation and economic growth will need to evolve. The tools and metrics we use to measure economic health may need to be the digital age. The generational divide. Another crucial aspect of the current economic landscape is the growing generational divide in economic experiences and expectations. Baby boomers, Gen X, millennials, and Gen Z each face unique economic challenges and opportunities. For baby boomers nearing or in retirement, the specter of inflation raises concerns about the purchasing power of their savings. Many in this generation benefited from decades of economic growth and asset appreciation, particularly in the housing market. However, they now face the challenge of making their nest eggs last in an inflationary environment. Gen X, often called the sandwich generation, finds itself caught between caring for aging parents and supporting their children. For many in this cohort, the current economic uncertainties come at a time when they should be in their peak earning years, adding extra pressure to their financial planning. Millennials, who came of age during the Great Recession, have faced unique economic headwinds. Many entered the job market during a time of high unemployment and stagnant wages. Now, as they enter their prime earning years, they're grappling with high housing costs and significant student loan debt. The recent inflation spike adds another layer of complexity to their financial challenges. For Gen Z just entering the workforce or still in school, the economic landscape looks markedly different from what their parents or grandparents experienced. They're entering a job market transformed by technology and facing the prospect of careers that may not even exist yet. While they benefit from new opportunities in the digital economy, They also face uncertainties about traditional paths to financial stability. This generational divide isn't just a matter of different age groups experiencing the economy differently. It has profound implications for policymaking, consumer behavior, and even social cohesion. How do we craft economic policies that address the needs of retirees while also providing opportunities for younger generations? How do we balance the desire for price stability with the need for economic dynamism and innovation? The housing conundrum. Given the outsized role that housing costs played in the recent inflation uptick, it's worth delving deeper into this critical component of the American economy and psyche. The dream of homeownership has long been a cornerstone of the American experience, a tangible symbol of success and stability. However, for many Americans, this dream is becoming increasingly elusive. Several factors contribute to the persistent rise in housing costs. 1. Supply constraints. In many desirable areas, especially urban centers and their surrounding suburbs, there simply isn't enough housing to meet demand. Zoning laws, building regulations, and community resistance to new developments often constrain the supply of new homes. 2. Material and labor costs. The cost of building new homes has increased significantly, driven by rising prices for materials like lumber and a shortage of skilled construction workers. 3. Low interest rates. While low interest rates have made mortgages more affordable for some, they've also contributed to rising home prices by increasing demand. 4. Institutional investors. In recent years, large institutional investors have entered the housing market, buying up single-family homes and converting them to rentals. This has further reduced the supply of homes available for purchase by individual buyers. 5. Changing demographics. As millennials enter their prime home-buying years, demand for housing has increased, particularly in desirable urban and suburban areas. The persistence of high housing costs has far-reaching implications. It affects household formation, with many young adults delaying marriage and starting families due to housing affordability issues. It impacts labor mobility, as high housing costs in economically dynamic areas can prevent workers from relocating for better job opportunities. And it exacerbates wealth inequality, as homeowners benefit from rising property values, while renters face an ever higher barrier to entry into the housing market. Addressing the housing affordability crisis will require a multifaceted approach. This might include re-examining zoning laws to allow for more dense development, incentivizing the construction of affordable housing, and exploring innovative housing solutions like tiny homes or co-living spaces. It may also involve rethinking our cultural attachment to the single-family home as the ideal living arrangement. The Fed's balancing act. Returning to the Federal Reserve, it's clear that the central bank faces a Herculean task in navigating the current economic landscape. The Fed's decisions don't just affect abstract economic indicators. They have real-world impacts on millions of Americans. If the Fed maintains high interest rates for too long in its fight against inflation, it risks stifling economic growth and potentially tipping the economy into a recession. This could lead to job losses and financial hardship for many Americans. On the other hand, if the Fed cuts rates too quickly or aggressively, it risks allowing inflation to reignite, eroding the purchasing power of Americans' wages and savings. Adding to the complexity is the fact that monetary policy operates with a lag. The full effects of interest rate changes can take months or even years to fully manifest in the economy. This means the Fed must not only respond to current economic conditions, but also try to anticipate future trends. Furthermore, the Fed must consider the global implications of its actions. The issuer of the world's reserve currency, Fed decisions ripple through the global economy, affecting everything from emerging market debt to international trade flows. In this high-stakes environment, every word from Fed officials is scrutinized for hints about future policy direction. The Fed's communication strategy becomes almost as important as its actual policy decisions, as it seeks to guide market expectations and maintain credibility. The political dimension. While the Federal Reserve is designed to be independent of political influence, economic policy inevitably intersects with politics. As we approach the 2024 presidential election, the state of the economy will undoubtedly be a central issue. Incumbents typically benefit when the economy is strong, with low unemployment and robust growth. However, persistent inflation can overshadow positive economic indicators, as voters feel the impact of rising prices in their daily lives. The current economic situation presents a complex narrative for both parties. Republicans may point to inflation as evidence of mismanagement, while Democrats might highlight job growth and rising reality, of course, is more nuanced than either partisan narrative would suggest. Moreover, the economic challenges we face don't have simple, politically expedient solutions. Addressing issues like housing affordability, the impact of technological change on the job market, or the long-term fiscal health of programs like Social Security and Medicare requires thoughtful, often politically difficult choices. As voters, it's crucial that we look beyond simplistic economic narratives and engage with the complexity of these issues. Our economic future depends not just on the decisions of policymakers and central bankers, collective understanding and engagement with these critical economic questions. Of financial literacy. As we navigate these complex economic waters, the importance of financial literacy becomes ever more apparent. In a world where economic forces can have such profound impacts on individual lives, understanding basic economic and financial concepts is no longer a luxury, it's a necessity. Yet, studies consistently show that many Americans struggle with financial literacy. A significant portion of the population lacks a basic understanding of concepts like compound or how the stock market works. This knowledge gap can lead to poor financial decision-making, from taking on too much debt to failing to save adequately for retirement. Improving financial literacy isn't just about individual well-being. It's about creating a more resilient and dynamic economy. Financially literate consumers make better decisions, are more likely to save and invest, and are better equipped to weather economic uncertainties. There's a role for everyone in promoting financial literacy. Schools can integrate their curricula. Employers can offer financial education as part of their benefits packages. Media outlets can strive to explain economic concepts in clear, accessible terms. And as individuals take responsibility for our own financial education, leveraging the wealth of resources available online and in our communities. The green economy and inflation. As we grapple with inflation and economic uncertainty, we must also contend with the pressing need to address climate change. The transition to a greener economy presents both challenges and opportunities from an inflationary perspective. On one hand, the shift to renewable energy and sustainable involve short-term costs that could contribute to inflationary pressures. Upgrading infrastructure, developing new technologies, and adapting existing industries all come with price tags that could be passed on to consumers. On the other hand, renewable energy sources like solar and wind, once established, can provide more stable and potentially lower energy costs in the long run. This could have a deflationary effect, particularly in energy-intensive sectors of the economy. Moreover, the economic costs of not addressing climate change, in terms of natural disasters, agricultural disruptions, and health impacts, could far outweigh the costs of transition. From this perspective, investments in green technology and infrastructure could be seen as a hedge against future inflationary shocks. As policymakers and business leaders navigate this transition, they'll need to balance short-term economic considerations with long-term sustainability goals. This balancing act will likely be a defining economic challenge of the coming decades. The future of work. The nature of work is changing rapidly, driven by technological advancements, shifting demographics, and evolving societal values. This transformation has significant implications for inflation, wage growth, and overall economic stability. The rise of remote work, accelerated by the COVID-19 pandemic, has reshaped the labor market. It has allowed for greater flexibility and potentially wider job opportunities for many workers. However, it has also led to disparities, with some jobs easily adaptable to remote work while others require physical presence. Automation and artificial intelligence continue to reshape industries, eliminating some jobs while creating others. This ongoing disruption can lead to wage pressures in different sectors, contributing to inflationary or deflationary forces depending on the specific context. The gig economy, characterized by short-term contracts and freelance work, offers flexibility but often comes with less job security and fewer benefits. This shift away from traditional employment models has implications for how we measure unemployment, wage growth, and overall economic health. As these trends continue to evolve, policymakers will need to adapt laws, social safety nets, and educational systems to ensure that workers can thrive in this new economic landscape. The challenge will be to foster innovation and economic dynamism while ensuring that the benefits of economic growth are broadly shared. This balance is crucial not just for economic stability, but for social cohesion as well. Moreover, the changing nature of work has implications for inflation that go beyond simple wage pressures. As more people work remotely, for instance, we may see shifts in housing demand away from expensive urban centers, potentially easing inflationary pressures in those areas while increasing them in smaller cities and rural regions. The gig economy, with its flexible pricing models, can lead to more dynamic and harder-to-measure price changes in various service sectors. As we look to the future, it's clear that our understanding of full employment, a key concept for monetary policy, may need to evolve. In a world of fluid, project-based work and AI-augmented productivity, what does maximum employment look like? How do we measure it? These are questions that economists and policymakers will grapple with in the coming years. The role of education in the economy. In this rapidly evolving economic landscape, education emerges as a critical factor in both individual success and overall economic health. The link between education and economic outcomes has long been established, but the nature of this relationship is changing in important ways. Firstly, the traditional model of front-loading education in the early years of life is becoming increasingly obsolete. In a world where technological change is constant and new industries can emerge in the span of a few years, lifelong learning is becoming not just beneficial, but necessary. This shift has implications for how we structure our educational systems, how businesses approach training and development, and how individuals plan their careers. From an inflationary perspective, education plays a complex role. On one hand, rising education costs, particularly in higher education, have been a significant contributor to inflationary pressures for many families. The burden of student loan debt has become a major economic issue, affecting everything from home ownership rates to consumer spending patterns. On the other hand, education, particularly in high fields, can lead to higher wages, potentially fueling wage-driven inflation. However, it also increases productivity, which can help keep inflation in check by allowing for economic growth without overheating. As we move forward, finding ways to make education more accessible, affordable, and aligned with economic needs will be crucial. This might involve rethinking traditional degree programs, expanding vocational and technical education options, and leveraging technology to democratize access to learning opportunities. The wealth gap and its economic of the most pressing economic issues of our time is the growing wealth gap. This widening disparity between the richest and poorest members of society has implications that go far beyond individual fairness. It affects the very functioning of our economy. From an inflationary perspective, the wealth gap presents a paradox. On one hand, concentration of wealth at the top can lead to increased demand for luxury goods and high-end services, potentially driving up prices in those sectors. On the other hand, if a large portion of the population has stagnant or declining purchasing power, it can lead to dearth in other parts of the economy. Moreover, high levels of inequality can lead to reduced overall consumer demand, as those with lower incomes tend to spend a higher proportion of their earnings in slower economic growth, which in turn affects employment and wages, creating a feedback loop that further exacerbates inequality. The wealth gap also has implications for monetary policy. When wealth is highly concentrated, the effects of interest rate changes can be unevenly felt across the economy. Lower interest rates, for instance, might disproportionately benefit those who own assets like stocks and real estate, while doing little to help those living paycheck to paycheck. Addressing the wealth gap is not just a matter of social justice. It's an economic imperative. Policies aimed at broadening access to wealth-building opportunities, whether through homeownership, retirement savings, or education, can help create a more stable and resilient economy. The digital economy and inflation. As our economy becomes increasingly digital, we face new challenges in measuring and managing inflation. The rise of e-commerce, digital services, and the sharing economy is changing the way we consume goods and services, often in ways that are difficult to capture in traditional inflation metrics. For instance, how do we account for the deflationary effects of online comparison shopping, or the value of free digital services that have replaced paid alternatives? The quality improvements in technology products that far outpace their price increases. These questions are more than academic. They have real implications for how we set monetary policy and how we understand the health of our economy. If our inflation measures are not accurately capturing these digital dynamics, we risk making policy decisions based on an incomplete or distorted picture of economic reality. Furthermore, the digital economy is blurring the lines between consumer and producer, with platforms like Airbnb and Etsy turning individuals into micro-entrepreneurs. This shift has implications for how we think about wages, prices, and economic value creation. As we move forward, developing new tools and metrics to understand inflation in the digital age will be crucial. This might involve incorporating big data analytics, revising the baskets of goods used to calculate inflation, or developing entirely new economic indicators. The role of government in the modern economy. As we navigate these complex economic challenges, the question of government's role in the economy takes on renewed importance. The traditional debate between free market advocates and proponents of government into a more nuanced discussion about how public policy can best support a dynamic, inclusive, and sustainable economy. In the context of inflation and monetary policy, the between fiscal and monetary policy becomes crucial. Government spending and tax policies can have significant inflationary or deflationary effects, potentially complementing or complicating the Fed's efforts to maintain price stability. Moreover, as we face challenges like climate change, technological disruption, and growing inequality, there's an recognition that market forces alone may not be sufficient to address these has led to calls for more active government involvement in areas like green energy investment, workforce development, and expanding the social safety net. At the same time, concerns about government overreach, the efficiency of public spending, and the long-term sustainability of public debt remained. Finding the right balance, one that fosters innovation and economic dynamism while ensuring economic security and opportunity for all, will be a key challenge for policymakers in the coming years. The global economic order in flux. While we've focused primarily on domestic economic issues, it's crucial to remember that the U.S. economy operates within a global context. The international economic order is undergoing significant changes, for inflation, trade, and economic growth. The rise of China as an economic superpower, the ongoing evolution of the European Union, and the emergence of new economic blocs are reshaping global economic dynamics. Trade tensions, geopolitical rivalries, and the push for greater economic self-reliance in many countries are challenging the post-World War II economic order. These shifts have direct implications for inflation in the U.S. Changes in global supply chains can affect the prices of goods and raw materials. Currency fluctuations can impact the competitiveness of U.S. exports and the cost of imports. And global economic uncertainties can influence investment flows and financial market stability. As we move forward, navigating this changing global landscape will require a delicate balance between protecting domestic economic interests and maintaining the benefits of global economic integration. It will also require a recognition that many of our most pressing economic challenges, from climate change to technological disruption, are global in nature and require international cooperation. The psychology of inflation. As we wrap up this exploration of inflation and its broader economic context, it's worth considering the psychological aspects of inflation. Economic behavior is not purely rational. Herd expectations play a crucial role in shaping economic outcomes. Inflation expectations, in particular, can become self-fulfilling prophecies. If consumers and businesses expect prices to rise, they may accelerate their purchases or demand higher wages, potentially fueling the very inflation they fear. This is why central banks put so much emphasis on anchoring inflation expectations, keeping them stable and aligned with policy goals. Moreover, the experience of inflation is often more psychological than the numbers might suggest. A 3% inflation rate might seem modest on paper, but for individuals seeing their grocery bills or rent payments steadily creep up, it can feel much more significant. This disconnect between official statistics and lived experience can lead to public discontent and pressure for policy changes. Understanding and managing these psychological factors is a crucial part of effective economic policymaking. It requires not just sound economic management, but also clear communication, public education, and a sensitivity to how economic policies are experienced by different segments of the population. Conclusion: navigating the economic. As we've seen throughout this exploration, the current economic landscape is marked by complexity, uncertainty, and rapid change. From the immediate challenges of managing inflation and interest rates to the longer-term issues of technological disruption, climate change, and evolving global dynamics, we face a daunting array of economic challenges. Yet, amidst these challenges, there are also tremendous opportunities. The same forces driving change, technology, globalization, shifting values, also offer the potential for innovation, growth, and the creation of a more sustainable and inclusive economy. Navigating this future will require adaptability, creativity, and a willingness to question demand collaboration across sectors, disciplines, and national boundaries. And it will require an engaged and informed citizenry, capable of understanding and participating in the complex economic decisions that shape our world. As we move forward, let us approach these challenges with a spirit of optimism and determination. The economy, after all, is not some abstract force beyond our control. It is the sum of our collective actions, decisions, and values. By working together, staying informed, committed to the principles of fairness, sustainability, and shared prosperity, we can shape an economic future that works for all. In the words of the economist John Maynard Keynes, the difficulty lies not so much in developing new ideas as in escaping from old ones. As we confront the economic challenges of our time, let us have the courage to embrace new ideas, the wisdom to learn from the past, and the vision to create a better economic future for generations to come.